We're going to talk about tax prorations now. How to calculate tax prorations for the closing day. How to charge the proper people, buyer versus seller, for the amount of taxes. So there's three possibilities. The first one is if we have a closing sometime in this time frame between January 1st and September 1st, or actually August 31st. So let's say the closing is on July the 7th. Anytime it's between January 1 and August 31st, we're going to debit the seller and credit the buyer the seller's portion of taxes. And that's because the seller has not paid for the whole year. They haven't paid at all. They weren't allowed to. You can't pay it until September 1st because that's when the bill comes out. So if you're closing on July 7th or any time before that bill comes out, you just got to take that money that the seller is responsible for and take it from them and give it to the buyer's side. Therefore, that's a debit seller, credit buyer for how much? The seller's portion of taxes. The other possibility is if we close sometime in this time frame, after September 1st or after, right? So one possibility is this. We're going to close here, let's just say like sometime, let's say October 7th. I'm stuck on the number 7, I guess. October 7th. So we don't have enough information. October 7th is our closing, and the seller has paid the taxes for the whole year. The bill came out September 1st. They had it available to be paid, and they paid it. Seller has paid for the whole year. Therefore, we need to give them some money back in the amount of the buyer's portion, because they're not going to be the seller's not going to be the owner while the buyer's the owner, obviously. So this case number 2 is closing after September 1st or after, and seller has paid the taxes already. And in that case, what we're going to do is credit the seller and debit the buyer. But what amount? Not the seller's amount, the buyer's amount of taxes, the buyer's fair portion of taxes. We're crediting to the seller because they are out of pocket for the whole year because they already paid them. We need to give them back some money. We need to give them back the buyer's portion. And then finally, number 3, the third possibility is again an after September 1, or again, I should say September 1st or after, and the seller has not yet paid. They've not paid him yet. In this case, we're still in this part of the year. We're closing October 7th again, but the seller has not paid. Therefore, we're going to have to, here's our October 7th, we're going to have to debit each side their appropriate amount. So we're going to debit the seller their portion, and we're going to debit the buyer their smaller portion. So it's one of these 3. So part of what you're going to need to be able to do is figure out which of these 3 scenarios you're dealing with, because it's 3 different ways you would handle it. So let's look at a problem. Okay, we've got a closing April 3rd. The annual taxes are $2,700 for the year. how are we going to handle this on the settlement statement or on the closing disclosure? Here's our April 3rd. Annual taxes are $2,700. Therefore, let's take our $2,700 and divide it by 360 days to get our daily taxes. 2,700 divided by 360. $7.50 per day. Now we need to know the number of days of the seller. Seller's days. If we're closing on April 3rd, well, that's 3 complete months for January, February, and March. So that's 3 months at 30 days each is 90 days, plus the number of days in the month of closing, so 93 days. Multiply those by those dollars per day of $7.50. So 93 days at $7.50 a day, $697.50. Now, that's the seller's portion. We'll close on April 3rd. That is before September 1st. Therefore, it's going to be a debit seller credit to the buyer for the amount of $697.50. We're taking $697.50 from the seller. We're putting it on the buyer's side of the transaction. And when that bill does come out later in the year on the September 1st, that buyer can take this $697.50, add it to the amount they're responsible for through the rest of the year, and send that total in to pay the tax bill. So that's the first example. Let's take the second example where we're closing September 1st or after, and the seller has already paid the taxes. Let's look at that one. All right. Let's see what numbers I use. We had $7.50 a day. Okay, we'll go with that. $7.50 a day is what we had calculated the daily taxes to be. You know how to do that already. I won't do that again. This time we are closing October 4th, and the seller has paid the taxes. So we've got our year here. October is our closing. Sellers paid the whole year, but we need to give them back some money. We need to give them back the buyer's portion. Don't forget, the seller owns the day of closing. Seller has to pay for it. So that day of closing counts for the seller. All right, so how many days does that mean? Well, if we're closing on October 4th, October is the 10th month. That means there's 9 total months, 30 days each. That's 270 days through the month of September. Add the 4th for October, so our days are 274 days that the seller is responsible for. What we need is the buyer days, though. I like it when you calculate the seller days instead of the buyer days, because that way you won't lose track of the day of closing. So easy to mix up the day of closing and put it in the wrong column. So if you always calculate the seller's days, you won't make that mistake as likely. So we've got seller's days. Now, let's go ahead and figure out the dollars. We know that it's $7.50. 274 days times $7.50 is $2,055. That's the seller's portion, but that's not the one we need, is it? Don't forget that either. That's the seller's portion. we need to get the buyer's portion. Buyer's responsibility. What's the buyer's portion? It's just the total minus the seller's portion. So we know the seller's portion is $2,055. I'm going to have to look back and see what our total was. It was $2,700. That's what we were working with. So $2,700 was the total. The seller's portion is $2,055. 2,700 minus 2,055 is $645. That's the buyer's portion, and that's the amount we need because we need to give that $645 to the seller. That means it's a $645 credit seller, debit buyer. Credit seller, debit buyer for $645. This is a mess on the screen here, but hopefully that makes some sense. So that was the second possibility. Let's look at the third and final possibility. We have a closing after September 1st or after, and then also the seller has not yet paid the taxes. All right, this time we're closing. We'll go October 4th. Taxes are $2,700 per year, which means $750 per day. This time, the seller has not yet paid for the whole year. Not paid yet. Here's our closing day of October 4th. This time we need to calculate the seller's days, including the day of closing, and the rest of the days of the year, which are the buyer's. So the seller's portion and the buyer's portion. Since the bill is available to be paid now, because we're after September 1st, then we're going to debit the seller their portion and debit the buyer their portion. So we need to calculate seller's days and buyer's days. Seller's days for October 4th, well, let's see, that's 9 total months times 30 days per month is 270 days, plus 4 days in the month of closing, 274 days. Is that the one I did before? Yep, it sure is, which was 2,000. It was $2,055 to the seller and $645 to the buyer. So it's going to be debit the seller their portion and debit the buyer their portion. So we just took these days to the seller and multiplied them by the $7.50 per day, and that gave us this $20.55. And then we just took that $20.55 and subtracted it from the $2,700 per year to get our $645. That's the 3 ways you would calculate tax proration.